Well, time to have a look at the markets picture, and for that, I'm joined all the way from London by Jamil Ahmed, who is the Director of Investment Strategy at NAGA. Jamil, thank you so much for your time this afternoon.
Thank you very much for having me. It's wonderful to be here.
I mean, I'm sure you paid attention to the latest Fed Reserve meeting. I mean, what do you make of what came out of it? Do you think the investors got the best possible outcome so far?
I believe so, because the Fed provided the necessary clarity. I think that before the meeting, it seemed to be that investors were putting up trees to see what falls down in terms of an apple, if it will hit the floor, and if the Fed will cause a surprise. And we had no such analogy come to play. The Fed were very assertive in their tone. I found that they will not be moving interest rates regardless of anything that happens with the Treasury yield curve or inflation, for as long as the economy continues to show that it's recovering from this pandemic, and that's going to take maybe 2 to 3 years. That's the realistic basis of it. I do think that before the meeting there was a little bit too much anxiety that the Fed could bring a surprise, but we know the Fed, they're consistent, they're very forward with their guidance too, and I think that essentially their conclusion is that yes, the dollar could get stronger if US economic data continues to get better, but essentially the major stock market indexes in emerging markets, S&P 500, should still find comfort that rates are not going anywhere higher anytime soon in the United States.
Speaking of anxiety, are you fearful that we could see higher inflation coming through?
I'm not fearful, but it's going to happen. It's a near uncertainty. As much as we can't say certain things in finance, but this is going to happen because you've had economies that have been locked down, hidden away for 1 year. You've had so much compressed demand, pent-up demand, and you've got a lot of supply that has not been used. It's only natural that when the gates finally start opening, and fingers crossed we are getting there and the traffic lights turn green again, that companies and consumers are going to try and recover that demand that they haven't been able to use. So that's naturally going to lead to a higher inflation outlook, and that's why there is concerns over what might happen with overheating inflation. But we have to look at it over a 2-year time stamp. Nothing really happened last year. It felt like life just stood still for many of us because of the lockdown conditions. And this year we're going to see things moving a lot faster because there's a lot more flexibility.
I was looking at the S&P 500 futures a little bit earlier on before we got on air, and they seem to be, it seems to be under pressure based on what's happening with the tech shares, and of course that move coming on the back of the US 10-year jumping 1.7%. What does that mean for growth stocks looking at that bond yield?
I think it's growth stocks and also it's looking for value. I think that technology shares is the one asset that we know is going to be due for a lot of volatility in 2021, because you have this tug of war between some economies on lockdown, but some economies are getting better, and more economies are going to get better over the coming months, and overall you've got these technology shares that are shooting higher in terms of market valuations. At some point something's got to give. So I think that because of the Fed standing very cautious on interest rate policy, that will support the major, more traditional stock markets, S&P 500, emerging market indexes and so on. But the economy is getting better in terms of vaccination speeds and reopening up, does mean that the technology shares, those star performers and diamond performers from 2020, they're in for a lot more turbulence up and down in 2021.
So we have these high-level US-China talks in Alaska, and there are rumors circulating, at least from the Beijing side, that they are hoping for a meeting in the next month between President Joe Biden and President Xi Jinping. I mean, we haven't talked China-US relations in a while. I mean, is this still stuff that we need to iron out and clarify, at least since the Trump era?
We do, because of the huge deteriorations in bilateral relationships, not between US and China only, but US and many countries, based on a lot of the more controversial tactics and policies that the previous administration implemented. So of course, yes, we have to monitor these talks, but we shouldn't give it as a given that the Biden administration is just going to go back towards a soft approach, because everything appears that Biden will still hit things hard. So that means the US and China relationships could remain frosty for some time. So we should also remember that in that culture, the Asian and Chinese culture, memories are hard to forget. So there was a lot of hurt that got accusations based on the Trump administration, and it will take time for those bilateral relationships to be anywhere near what it was prior to that administration coming into place. And I think there's going to be a lot more time that Biden administration needs to kind of earn that trust.
Right. What news events are you keeping an eye on?
Essentially, in terms of economic data, I'm looking at the Bank of England interest rate decision that's due any time now. The UK economy is obviously very superior in terms of vaccine distribution so far, but we can't also forget and discount that the UK economy has had its first worst economic shutdown in terms of catastrophic downturn for 300 years. So I think that, yes, the Bank of England will be more upbeat that the vaccine's getting better, but there's still a lot of uncertainty based on the economic shock the UK has had. But then we have to look at the vaccine speed and the rollout as well, where countries like Europe, the European Union, and that continental group, they are very much behind the curve on where they should be with the vaccine rollout. And that leads to some concerns that the dollar can continue to get stronger, and it might actually be the euro and the weak distribution in the European Union that actually means that emerging market currencies like the rand, like the Turkish lira and the Russian ruble, they will not provide as much enjoyment in the stock market sentiment as perhaps they should when the S&P 500 is just closed at new all-time highs.
All right, Jamil, thank you so much for your time this afternoon. That is Jamil Ahmed, who is Director of Investment Strategy at NAGA. We'll have more news coming up after this short break.